Well, enough about gold and silver. Let's take a look. They're doing fantastic as I speak here. Uh, let's look at some other things like the stock market, some energy companies, that kind of stuff. Chesapeake plunges 40%, according to Bloomberg. 40% on report, it hired a restructuring advisor, like as in, we're about to be going bankrupt. Chesapeake Energy Corp., the U.S. natural gas driller that's been slashing jobs and investor payouts to conserve dwindling cash flows, lost half of its value after a report that it hired restructuring attorneys. The shares dropped a record 51% after DebtWire reported that Chesapeake retained Kirkland and Ellis to help restructure a $9.8 billion debt load. The plunge triggered 3 circuit breaker halts during the first half hour of trading and extended Chesapeake's 12-month loss to about 93%. The free fall wiped out $838 million in market value in the first hour alone on Monday. Burdened with a debt load 8 times larger than its market value. Hold on. Did you catch that? Burdened with a debt load 8 times larger than its market value, Chesapeake has been canceling drilling projects, trimming its workforce, and closing offices to slow the rate at which it burns through cash. Gas, which accounts for about 80% of Chesapeake's production, has averaged about $2.56 per million, $2.56 per million British thermal units, or BTUs, during the past year, down 38% from a year earlier. Burdened with a debt load 8 times larger than its market value. Do you think for 1 second this is the only story you're going to hear that's similar to this from some energy company, or any company for that matter? So-and-so company, debt burden 10 times its value, 2 times its value, 3. It doesn't matter how many times. If the debt burden's higher than what the freaking whole company's worth, it's like a walking dead man. Put him on the plank. Done. Make him walk the plank. So we have some of the top stocks that you'll know very well. They are called the FANG stocks. Facebook, Amazon, Netflix, Google. The big boys, the big stocks. And it ain't looking so good. Matter of fact, can we give you a little glimpse of this? This is the chart I had a little while ago. We'll get rid of that. Get rid of that. Let's just add this real quick, if you don't mind. Courtesy of Zero Hedge here. Let's see if we can. Oh, I can't click on that one. But you can see all of these babies. Oh, rebound. Everything's cool. Everything's good. Oh, no, wait. We're crashing. Never mind. I'm trying to see what time frame this is from. I cannot see the bottom of that chart. It's very hard to see. So it's carnage in the pre-open, according to Zero Hedge. The FANG stocks, as he says they've been defanged, are collapsing in the pre-market as faith in the growth at any cost meme crashing on the shores of reality once again, now down over 16% from their post-Fed rate hike highs. The Fed did that in just December, month and a half ago roughly. Rate hike, remember that? So you're telling me in a month and a half's time, 16% wiped off the board from these big, mammoth, behemoth, very well known and supposedly strong companies. What was that thing Lindsey Williams used to say? If it's written on a piece of paper, it won't be worth the paper it's written on when all this crap comes crashing down due to the derivatives crisis that the club will throw out in our faces and deal with. For those following my stock moves, this is a quote, I just bought puts against my entire Netflix position, Cuban posted on the site. I'm not selling, but I have no idea what this market will do. Which, end quote, which will drag the broad fangs to 5 month lows. I have no idea what this market will do. I do. Can I speak? No? Oh, okay. Sorry about that. As we noted earlier, via JP Morgan's Kalanovic, he says, for instance, a popular group of stocks held by investors is known as the abbreviation FANG. Facebook, Amazon, Netflix, and Google. We use the stocks or these stocks as an illustration for a broader group of similar stocks that have the highest rankings according to momentum and growth metrics. I bet that energy company, Chesapeake, was a high-ranking company at one point in time, not too long ago, and now it's got a debt burden 8 times its value. So these have the highest rankings according to momentum and growth metrics, and surprisingly in some cases even low volatility metrics. Given that traditional value metrics look expensive when applied to this group, one can compare these momentum/growth companies on a new set of metrics. For instance, one can look at the ratio of current price to earnings that the company delivered over all of its lifetime instead of just the past year. Another metric could be a ratio of CEO or founder's net worth to total company earnings delivered during its lifetime. See below. Aggregating all FANG earnings since these companies were listed, one arrives at a ratio of current price to all earnings since inceptions of 16 times. This can be contrasted to a ratio of price to last year's earnings for all other S&P 500 companies, also at 16 times. We think this is extraordinary given that FANGs are neither small nor new companies. In fact, these are some of the largest companies in the S&P 500 and among the largest holdings of U.S. retirees. Given that the 3 largest FANG stocks are now twice more valuable than the entire U.S. S&P small cap universe, 600 companies, a legitimate question to be asked would be, is such a high allocation by long-term investors to these stocks prudent? Statistically, over a long period of time, smaller companies outperform mega caps 75% of the time. Note also that the current size ratio of mega cap stocks to small cap stocks is at the highest level since the tech bubble of 2000. Furthermore, such allocation is also questionable from a risk angle. For example, the idiosyncratic risk of holding 3 stocks in one sector is certainly much higher than the risk of owning, for example, 1,000 medium or small cap companies diversified across all sectors and industries. So in other words, the S&P, which is heavily into these companies, might not be a good idea to be in. Finally, we leave with the thoughts of infamous Macro Man. Just say no to equity market drugs. So he says, long FANG and short GDX was a prodigious trade over the last few years, with that spread rising more than tenfold from Facebook's IPO in May of 2012 to Thanksgiving of last year. The high was great while it lasted, but coming down has proven to be unpleasant, to say the least. If you wanted one chart to illustrate the pain in equity space, this would be the one. And just take a little peek at that. I'm assuming he's talking about this bad boy right here with this nice little arrow showing you where this puppy is ultimately going to go. So then we also have, again, thanks to Zero Hedge, European bank bloodbath crashes bond / stock markets. Just as we warned, not only is it time to panic, but the panic is contagioning over into sovereign risk market, into the sovereign risk market. European banks are in free fall, down over 4.3% broadly, crashing to 2012's whatever it takes lows. European bank risk has gone vertical. Today's spike rise is the largest since April of 2010. Too big to fail banks are all seeing credit risk explode to 52-week highs and beyond. Isn't that shocking? No. Slamming European bank stocks back to near whatever it takes lows, as I mentioned, dragging the entire European stock market down 24% from its highs to 16-month lows. And that risk is systemically crushing peripheral sovereign bond markets. Is it time to panic? You betcha. All eyes are focused on the synthetic run on Deutsche Bank. And you've heard me mention Deutsche Bank once or twice, or maybe a dozen times over the last couple of years especially. So since Europe unleashed their bail-in regulations, European banks have utterly imploded, with Deutsche Bank most systemically affected, as it seems more than one person is betting that Deutsche Bank will be unable to raise enough capital and will be forced to haircut depositors on up in the capital structure. Finally, for those desperate dip buyers hoping for another move from Draghi, don't hold your breath. As Deutsche Bank itself warned, any more easing by the ECB or Bank of Japan will only hurt banks, and certainly Deutsche Bank. And in other words, they are officially trapped now. If you ease, you're screwing us. If you don't ease, we're screwing ourselves anyways. And these are, which I'm going to show you this. Nice little chart here. Let me see if I can make that a little bigger. Here we go. Let me scoot my bald head out of the way. Credit defaults swaps, 5 years. Okay. You got 2011 and a half, if you will. 2012. Let me move my mouse over here. 2012, 13, 14, 15, 16. And you can see as we just entered 2016, right? Look at the last several years. Little moves here and there, right? But generally, you know, I mean, it's not too, I wouldn't look at that and say it was stable, but it was generally okay, right? Credit default swaps. All of a sudden, wham. Look at that line. Credit default swaps are insurance contracts. And we dealt with those in 2008. That's why the company AIG got bailed out. They were the insurance company that had to pay out credit default swap contracts to the failing banks. But as any insurance company on the face of the earth, which is true, this is true for all of them, by the way, shouldn't be shocking to you, they don't have enough money, none of them, to insure a catastrophic event. In other words, oh my God, I'm a Progressive Insurance, massive auto policies out there. We're making some good money. Holy crap, Monday morning, 25% of all of our cars, insurers, got in a car accident and it was major damage. We don't have enough money to handle 25% of our entire clientele in the auto industry. We're done. We're finished. We're wiped out. And that means, hey, I got in a car accident today. I'm calling. We're sorry. The number you dialed is no longer in service. What the? But I just got my policy document. Right? But you would say, well, that's a catastrophic event, Jason. If that would, you're not going to see that. 25% of people are going to get in a car accident. Correct. I'm just using that as an analogy. But it already happened in 2008 with AIG. The bankers were failing. The banks were failing. And we got to get this credit default swap paid, this insurance contract, because we owe money to so-and-so bank, and they owe money to so-and-so bank, and it was a big daisy chain. Big daisy chain. And this one couldn't pay that one because they didn't have the money to pay that one. And if this one can't pay that one, then that one can't pay the next one. But AIG's insuring us. I'm with AIG. We don't have enough money to insure even the first one of you. Don't worry about it. Treasury Secretary Hank Paulson and little Timmy Geithner and follow will take care of it. Everyone's getting bailed out. Banks are getting bailed out. And AIG, you're getting bailed out so that you can help bail out the banks. That's how that went. This already happened. And it crushed AIG, except the Walking Dead man was brought back to life by the U.S. federal government via you, the taxpayer. And now things are multiples of times worse. So these credit default swap, this is, if you're a bank and your name on this chart says Deutsche Bank, and this is your chart for credit default swaps, 5 years, 2016 starts in January and it skyrockets straight up. I wonder what that means. It might mean that Deutsche Bank is a walking dead man and may in fact be bailed in by the taxpayers, or the not necessarily the taxpayers, the account holders. And remember, if your account's got more than 100 euros in it, or whatever the hell it is over there, we have FDIC insurance here. It's 250,000 in America. I don't know about in Europe, but whatever the hell theirs is, anything above that, it's gone, and it's gone. Like South Park said. Yeah, but I had 300,000, and it's gone. Next person, please. Bailed in, Deutsche Bank. That's why they passed. Again, did they just pass regulation recently? Did they just change that law recently with bail-ins? No. It was finalized a while ago. These bankers know what they're doing. They deal with stuff in advance. They do these things so that when the time comes, the laws have already been passed. There's no need to panic and create a new legislation. They got their stuff together way before everyone else could figure out what has even happened. And their method of choice right now is bank bail-ins. So, again, the way that works is whatever the insured amount at your bank is, anything above that in your account can be and will be completely wiped off the face of the earth and essentially given to the bank to help shore up their balance sheets and whatnot. And when they were raking in all of that money, you didn't get none of that. You just banked with them, had your little money in their account. And then they recklessly abused that money, bet on things, became investment banks, no longer just a bank, an investment bank on top of being a normal bank. Gambled it all away. Sorry about that. We need a bail-in. You schmuck. You got 300K. What's the limit? 150? Yes. 150 of yours is gone. And one part of you says, man, I feel bad for the people. This is so wrong. God, I don't want to see people upset like that. It's going to really upset them. But the other side of me says, you stupid son of a bitch. You uninformed moron, you idiot. Turn off that goddamn Super Bowl and pay attention to what the hell's going on. That's what the other side tells me. How much could that 150K you just lost have bought you in silver or gold? Probably a lot of silver. You may want to stick to gold because you can get a lot less gold than you can in silver for that kind of money. Therefore, you don't need a giant safe in your house. Nope. I've got full faith, trust in my government. And you too shall learn the hard way, as history has proven. Take care.